Big tech is making billions from AI investments while spending even more billions to build AI. The AI dinner is going great. The check just keeps finding another seat. That sounds like a joke, but the accounting and contracts are very real. Start with Amazon, because its Anthropic relationship now has almost every financial role on the table. Amazon owns Anthropic Securities, sells Anthropic AWS compute, and can also provide Anthropic financing. In its first quarter filing, Amazon said private company equity investments carried a value of $48.1 billion. Those holdings primarily included Anthropic and OpenAI, and observable price changes can flow through other income. After March ended, Amazon invested another $5 billion in Anthropic preferred stock. It also amended the AWS commercial arrangement and created a financing facility of up to $20 billion. Importantly, that facility does not begin as a giant blank check sitting on Anthropic's desk. Availability grows as Amazon reaches compute delivery milestones, and Anthropic can then choose whether to draw. So Amazon can be investor, cloud supplier, and potential financier in the same relationship. Corporate strategy has apparently discovered the combo meal. Now add SpaceX, where the relationships get even more unusual. A June securities filing says Google agreed to buy access to roughly 110,000 NVIDIA GPUs from SpaceX. Google is scheduled to pay $920 million per month from October 2026 through June 2029. SpaceX separately disclosed Anthropic agreements covering roughly 325,000 NVIDIA GPUs at $1.25 billion per month. These are real compute contracts, not imaginary arrows added to a YouTube thumbnail. And that distinction matters because real demand can coexist with very complicated financial plumbing. Reuters. Breaking Views highlighted another layer: huge paper gains from rising private company valuations. It calculated Alphabet's historical SpaceX investment helped produce a $98 billion other income gain after SpaceX went public. Amazon has also recorded major revaluation gains tied to its Anthropic holdings. Paper gains are not fake profits, but they are not the same thing as cloud customers paying cash. Your brokerage app may show one earnings number. The plumbing underneath can be doing 4 different jobs. Meanwhile, the cash spending is extremely real. Amazon just reported AWS revenue up 37% to $42.2 billion and raised 2026 capital spending to $220 billion. So, this is not a story where AI demand disappears when somebody opens the filing. The server room is busy. It just brought a mortgage-sized receipt. Here is the clean way to read the case. Separate operating profit from investment revaluations, then separate both from financing commitments and capital expenditures. If those 4 buckets are growing together, headline net income becomes a much noisier measure of AI economics. That does not prove a circular scam, and it does not prove the same dollar literally travels in a loop. It proves the ecosystem has overlapping roles, where investors can also be suppliers, customers, and financiers. Who wins? Companies that secure scarce compute, valuable equity stakes, and long-duration customers can all benefit. Who pays? Ultimately, somebody still has to fund the chips, power, data centers, interest, and cloud bills. Before celebrating who picked up the AI check, check who financed the card and who owns the restaurant. For investors, the next useful question is not whether AI is real, It is where the cash actually lands. Price is surface. In this case, the money relationships are the message.